This is the single biggest threat to banks, and nobody's talking about it, and it's not interest rates. This same threat is why preserving, let alone growing core deposits has become more challenging and not less. It's also why you've had to increase your deposit rates much higher than you would have thought by now, even though the Federal Reserve is either done or close to done increasing interest rates. And it's also why some of you have become increasingly dependent on expensive sources of funding, such as brokered CDs and Federal Home Loan Bank advances. And this threat is called quantitative tightening, also known as QT. In this video, we're going to talk about what QT is, why it matters to you, and most importantly, what you can do about it. Let's get to it. First, what is QT? QT is the Federal Reserve's plan to reduce the size of its balance sheet. This may seem innocuous, but a closer look on how the plumbing of QT works will quickly reveal why QT is such an imminent threat to the banking industry. The Fed shrinks its balance sheet by reducing the size of its securities portfolio. Say the Fed owns a mortgage-backed security or a treasury bond. Say the Fed gets paid back. The Fed is receiving money like any other lender would back from the borrower. But if the Fed doesn't take that money and purchase a new security, that money is essentially removed from the economy and the banking system. In a nutshell, QT, by removing money from the banking system, is a deposit destruction machine. QT has already inflicted massive damage on the banking industry. The banking system has lost nearly $1 trillion of deposits in less than 14 months. We have never seen deposits sucked out of the banking system like this ever before. If QT continues as the Federal Reserve has planned, we could stand to lose another $1 trillion or even more over the next 12 to 24 months. By the way, this is not a forecast. The Fed has already told us they plan on doing this. This means if you want to grow your core deposits, good luck, because you are going to have to grow them into a shrinking pie. Now, large banks will take the immediate hit from QT, but it's how the large banks respond that really affects smaller banks. See, here's the thing. Large banks will have a low tolerance for losing deposit. And the reason is because they have a liquidity coverage ratio they are required to comply with. And if they lose too many deposits, they won't comply with that ratio. So they're gonna have a very low tolerance. And what that means is they're gonna roll up their sleeves and they're gonna come after regional banks' deposits and community banks' deposits. And guess what? The regional banks are gonna come after your deposits too, as the larger banks take deposits from them. Do not make the mistake of thinking your bank is safe just because there's no JP Morgan or Bank of America branch in your footprint. But it's not just other banks that community banks need to worry about. QT is also forcing banks to compete with money market funds who still have tons of excess liquidity parked at the Fed because there is such demand for money markets because of the yield they are offering relative to what banks are offering. And there is even more competition coming for your deposits, and it's already been coming, in addition to the money market funds. That is our own federal government. If and when we get through this latest debt ceiling debacle, the federal government is going to flood the market with treasuries. The question is, who is going to buy them? Guess what? The two largest buyers over the past decade, China and the Federal Reserve, they're out of the market. And that really leaves, at the end of the day, one buyer left. And that buyer is the public. And the public means your deposit customers. The bottom line is liquidity problems in the banking industry are far from over. And all of this competition for a shrinking pie, not only amongst banks themselves, but with money market funds and our own federal government, is going to force banks to increase their deposit rates, even if the Federal Reserve is done increasing rates. One more thing, don't make the mistake of thinking you are safe just because you have plenty of availability on your Federal Home Loan Bank line or your Federal Reserve Bank line. Liquidity risk is about fear and confidence. Just ask the management team and boards of directors at First Republic Bank and PacWest Bank. QT should be treated as an immediate strategic problem. It's not a tactical one. Now that you understand the basics of QT and why it's such a threat, let's talk about what you can do about it. There are certain things you can do to mitigate QT's impact and position yourself for success in the long run. Number one, cleanse your balance sheet as much as possible as soon as possible. In other words, let's put the word balance back into the balance sheet. This means stop waiting for God and liquidate your underwater securities as much as your capital will allow you to. You can then use the proceeds to pay off your most expensive liabilities instead of just continuously borrowing at the most expensive rate from the home loan bank or from the brokered fund market. By the way, mark my words, if you have to shrink your balance sheet and sacrifice earnings in the short term, so be it. You will be much better off irrespective of how severe this liquidity storm is going to be. Number two, get your guardrails right. I mean, you need to have internal limits that are well defined that prevent risks from getting out of control. Let me give you a few examples. How much brokered deposits and wholesale funding as a percentage of assets are you willing to tolerate? Or how low will you allow tangible book value, which includes unrealized losses in your securities portfolio, as a percentage of assets go? These limits must be crafted in a smart way, or you will have nothing concrete to guide you through this storm. But here's the thing, you don't want the guardrails too loose so they have no teeth in them. But you don't want them too tight either, where they continuously trigger false alarms and it becomes white noise to your management team and your board. Data and analysis is required to figure out what these limits should be. And oh, by the way, perfect place to keep these limits is in a capital plan. The third thing I strongly recommend that every bank does is stress test your liquidity to assess your risk so you can build a contingency plan. But if you are going to stress test your liquidity, you have to do it properly. The old way of just checking to see if you have enough availability on your Federal Home Loan Bank line or your Federal Reserve Bank line to cover any shortfalls is not going to cut it anymore. And I don't care if that type of exercise satisfies your examiner in charge. This is about preparing for a Category 4 or 5 liquidity storm, not making your regulator happy. A properly designed liquidity stress test is going to prioritize on-balance sheet liquidity and be less dependent on off-balance sheet liquidity to be realistic and in compliance with the limits that you set in your capital plan. Think of it this way. How comfortable would you be as a lender if one of your C&I customers told you they were having structural cash flow problems, but everything was okay because they had a line of credit that they haven't fully tapped into at your bank? But everything's okay because they have plenty of receivables to pledge. That's not going to make you feel great as a lender, is it? This isn't that much different. Look, I am not bashing the Federal Home Loan Bank or the Federal Reserve Bank. Every bank, if they can, should have a line of credit at those two institutions. They are wonderful resources, but those lines are best used to fund growth in good times and short-term temporary problems. QT is not a short-term temporary problem. Mark my words. If you treat it like one, you will learn to regret it. Thank you for watching this video. Make sure you hit the subscribe button so you don't miss more videos like this.